clear as day that economies everywhere face a long slog back from the COVID-19 crisis. Hobbling the recovery will be behavior changes riding on the back of income losses. That's how JP Morgan's chief economist forecasts the second half of 2020. I asked him about the India outlook too. Here's what he said.
We're of the mind that India is going to be going through a very difficult first half of the year. We have GDP down in the second quarter at 35% annualized pace, but we have a very strong rebound in the second half of the year, but one that still doesn't get you back to where you were. We are worried significantly about the deterioration in public finances. We think the RBI is now almost done, but not completely done with the easing that it is going to be doing here. We have a bottom in the policy rate forecast, very close to where we are now at 375. I think the issues in terms of the stresses on public finances, the stress of having had huge social disruptions through this event are going to be difficult ones to forecast and think about how they're going to linger. As I said, for South Africa, I think it's also true for India that there's going to be needed support from the central bank in helping to fund what we expect to be pretty large ongoing budget deficits here. And I think the hope is that you can get through this without having to suffer more severe financial stress. But the path ahead is, ongoing problems on public finance, incomplete recoveries on growth, limits on how far policy can go, even though they're doing more than you might have thought looking back a few months ago. But an economy that's able to make its way back here, at least partially, with some pretty strong growth as you look ahead for the next 2 or 3 quarters. 3 basic points about how we put the outlook together. The first and most obvious one, because I think we're seeing it already, is that we're in the midst of a historic move down in activity as a result of the COVID-19 shock. It is, in our mind, going to be the deepest move down in activity that we have seen, at least since World War II globally. And it's pretty similar in terms of the view as we look at it across countries. For those of you who have the chart book in front of you, you can see the chart on page 6, I believe, of the chart book, 5, excuse me, which shows you the annual growth in 2020 in a historical perspective. And you can see, again, as I said a minute ago, deeper than anything we've seen since World War II, one of the 3 or 4 deepest events in terms of the decline in activity that's taken place over the last century. At the same time that it's going to be deep, we also believe it's going to be very short-lived. And we're looking for growth rates in the second half of the year, which are also unprecedented in terms of the lifting coming out of a recovery. Globally, we have growth rates running between 15 and 20% annualized. That comes after similar size declines in terms of growth rate during the first half of the year. I want to talk in a minute about why we're going to get that lift, but I want to get the third point out also, which is that the extent of the recovery is going to be partial. And what we are looking for is a deep downturn, a quick and very strong recovery, but a partial recovery that leaves us with a lot of damage in the global economy that's lasting. To put a number on that, to start, if those of you have the chart book want to look at it on page 9, the key reference point we're using is where the level of GDP is versus the path we had predicted before the virus came on the scene. For the global economy, that's a loss of about 5% of GDP at the end of this year. It only declines to something a touch below 4% at the end of next year. And therefore, we're in the midst of an event which, in terms of unemployment, in terms of income loss, in terms of the levels of GDP, continues to linger here for some time. Now, what I want to do beyond the obvious, which is that this event, in terms of the disruptions that came from containment measures, has produced a big downturn, is argue why we can get a big bounce, and then also why the bounce is likely to be partial and not bring us all the way back. On the reasons for getting the big bounce, one of which I think we can see already, which is that containment measures have been successful and they are now producing a relaxation in activity. We saw it already well underway in China. And in China, you can see in the March and April activity readings some fairly strong results. The openings have begun in Western Europe, in the Americas, and we think the recovery broad base will be underway globally before the middle part of this year. What the China data is telling you, and I think it's important, is that from very depressed starting points in activity, small changes in terms of the containment measures can give you big initial rebounds in growth. We also think that you're getting this rebound because of the fact that the Fed, other central banks, and policymakers more broadly have done a very good job limiting the magnification of the damage to financial markets. Credit markets continue to function. Credit is actually growing at a rapid pace in the US and Western Europe. Emerging market economies are seeing capital continue to flow in. These are things which could have turned out far worse if policy hadn't stepped in and done quite a good job of limiting these magnification effects. The third reason to expect rebound is because we've gotten the stimulus that we have. It's our estimate that the fiscal stimulus we're getting globally for this year is going to be exceeding 3% of GDP. To put that in context, the stimulus we got after the global financial crisis in 2009 is, by our estimates, about a percentage point less than that. So there's a huge stimulus. There's been success in containing the crisis to not hit financial markets, and we've succeeded in putting ourselves in a place for starting to relax. Those are the catalysts, that's the recipe for getting this big initial lift. What is the reason why the lift doesn't take us all the way back? Well, again, I want to emphasize three things here. The first is that the virus is contained. The virus is going to start to gradually move out of the frame, but it's not going to go away. We don't have a vaccine. Certainly we might get one, but that's not built into our baseline forecast. We're also not building in a big second wave outbreak, but we do look at the world as having to deal with the virus in terms of some containment measures, in terms of consumer fears that's lasting for some time. So activity, behavior not going back completely to normal. The second issue here, and I think it's the biggest one, is that there are big income losses that are taking place right now. Even though the event is short-lived, the income losses in terms of people losing their job, in terms of corporate profits going down, these are very big. They're going to create damage to balance sheets. They're going to create damage not only on the private sector balance sheet, but also in the public sector side to support those. And those impacts are going to have a lasting effect on behavior. One point we try to make in our research is how different it's going to be for the household sector as opposed to the corporate sector. We do believe a lot of the supports that you're getting from governments are coming in the form of enhanced unemployment benefits or wage subsidies or checks, as we're doing in the United States. These are things which are giving the household sector a lot of income cushion through the bad time here. That is going to be quite positive in terms of sparking the initial leg of the recovery, but both because of the caution I described a few minutes ago from behavior, as well as what we believe is going to be ongoing concern on the household sector side, particularly in places like the US where labor markets have gotten hit so hard about job insecurity. We don't think the multiplier of those income supports are going to be all that great. That's why we think the household savings rate in the United States, which we're expecting to get up on Friday in the April income report towards 25%, is not going to come fully back down to the about 7% level it was at the start of this year. In addition, and perhaps even more importantly, while the household sector is being supported by income transfers, the corporate sector, firms more generally, are being supported by credit. What you're seeing in terms of the way that governments are helping corporates is through some combination of government guarantee loans or easier access to lending through a whole host of different schemes. And that's really important for bridging the cash flow gap that takes place here through the bad times, but the loss of income is not being reversed. The rise in credit is not going away on corporate balance sheets. And as we go into this expansion, we will have saved a wave of bankruptcies during the crisis, but we will leave the corporate sector in less strong position to drive a recovery. And that is, in our mind, going to be an ongoing and somewhat lingering drag. The third point here is, I think, policy fatigue. Fatigue may not be the right word, but there's an enormous amount of stimulus that's being put in place right now. It's being designed to handle an emergency. The stimulus is not designed to last beyond this year in almost every case. And in order to not have a very large fiscal drag in 2021, you're going to need to see active policies to extend these. Some of that will happen. We do expect more stimulus to come in the United States. In fact, we're looking for another $1 trillion of stimulus through packages that are still being debated in Washington. We expect more stimulus to come elsewhere as well, but not enough to prevent through 2021 fiscal policy to be fading in its supports and fading in its supports in a way that does provide a drag on growth. The interesting difference, I think, between the US and Western Europe is worth noting in this regard, where Europe is providing its supports through stimulus to the labor market by helping people stay in jobs. The US is allowing for the traditional flexibilities of the labor market to operate. That's why we will have another very ugly employment report with millions of people losing their job when the May reading comes out a week from Friday, and probably an unemployment rate that goes up closer to 20%. But at the same time, those things create different dynamics going forward. The US tends to have more dynamism in terms of the lifting out of recessions because of that. The Europeans tend to have weaker lifts, partly because corporates are still holding all of that labor cost on their books, and we're having the balance sheet dynamic that we talked about a minute ago. So it's an interesting contrast of systems. From our point of view, the US gets hurt more initially in labor markets, comes back quicker. Right now, we're not distinguishing in a significant way the amount of damage being done to the two economies when looked at over an 18-month period, but it's an important test. It's something worth watching. The last couple of things I want to talk about are, first, inflation, where there is both demand and supply dynamics which are at work here. There is disruptions to supply chain. There are cost increases that are going to be required across a number of sectors to deal with the healthcare problems that are going to be ongoing. That's going to feed some price increases. But in our mind, the bigger effect here on inflation is going to be the ongoing weakness in demand, the loss in output that we talked about earlier. Output gaps are going to be pretty similar to those GDP losses we talked about. We have an output gap of a little over 3% for the global economy at the end of next year. That's a huge amount of slack that's going to weigh on pricing, and particularly in our mind in the services industries, which generally don't see pricing move, but are being specifically affected by this event. The final thing I want to just emphasize is that anytime you go through a crisis, it has repercussions through the political process. It is, I think, something that an economist like myself would probably be careful to be humble in terms of our ability to forecast what happens on the political side. I would note that after the global financial crisis, there were a combination of political dynamics which helped, which hindered the recovery, and it helped contribute to what was a very subpar decade. How politics responds to this crisis, I think, is a big factor for what we're going to see in terms of the ongoing and longer term effects of this. I would note in that regard that it's encouraging to see the announcements last week by Merkel and Macron to talk about a European recovery fund, which starts to deal with some of the issues around burden sharing in the region, which certainly is going to build pressure here, and also starts to deal with some of the institutional problems you have in Europe, where you don't have a common fiscal authority to deal with shocks of this nature. At the same time, I think there are other things to be concerned about, US-China relations being one, the Brexit negotiations being another. And there are a whole host of things we can talk about related to the lack of coordination going on a global level.